At the open for the local market, Cameron Peacock from IG joins us from Melbourne now. Cameron, great to see you there. It was a pretty bad end to the week, wasn't it, offshore? What's that going to mean for us at the open?
Yeah, good morning, Bridie. Look, after those strong gains last week for our market of 1.9%, unfortunately, we look like giving a lot of that back on the open today, with the local market called down about 52 points or 1.1%, around that 45.19 level. Now, of course, the losses expected today are predicated on those the big sell-off we saw on Wall Street on Friday, where we had the Dow Jones down more than 200 points or 1.5%. We had the S&P down 1.8%, and I think the Nasdaq down about 2.2%. But I do think we need to put those losses in context. Despite the big sell-off which we did see on Friday on Wall Street, the Dow Jones and the S&P were still in positive territory for the week. Now, obviously, the reason behind the sell-off on Friday on Wall Street was predominantly due to corporate earnings, particularly tech earnings. Earlier in the week, we saw IBM and Google disappointing the market, falling short of expectations. On Friday, it was Microsoft's turn, and on the back of that, we saw the tech sector as the worst performing sector. On Friday, it was down 2.4% and was the reason why the Nasdaq was the worst performing indice for the week. We also had some of those bellwether names like GE and McDonald's, which are real bellwether names in terms of the economic outlook, falling short of expectations. So a pretty dismal week for earnings in the US, and really confirmed that the fears that we had heading into the earnings season, that this earnings season was going to be a poor one, and really reflecting some of the global slowdown fears that people have been talking about for the last couple of months. So unfortunately, we look like being having a fairly soft start to the week today. It's going to be a real risk-off session. We did see that on Friday with the materials, the energy, some of those key sectors down more than 2%. We had the US dollar a little bit stronger. We had base metals weaker. We had gold down about $16 to current levels of $17.21. Oil prices were lower. We've got BHP's ADR this morning called down about 56 cents or 1.6%. So across the board, I think we're going to see some broad-based weakness across our market. We also had, I think, Goldman Sachs coming out over the weekend and downgrading NAB and Westpac on earnings fears. So I think it's going to be a broad-based sell-off today. But the one thing I would say is if you were bullish on the market on Friday, which a lot of people were, today's probably a great buying opportunity. I don't think anything fundamentally has changed in the world from Friday. We just saw a little bit of profit taking and a bit of a sell-off after a strong recent run. So a lot of people are going to be asking the question, is this the start of a correction? I can see that question being asked numerous times today. My response to that is, we'll only know there's a correction once we've seen the market pull back 10%. Until that time, you've got to look at today as just a pullback after a strong recent run, and we see that in these markets, and it shouldn't be anything to be too concerned about.
You mentioned there the broker downgrades for the banks. Merrill Lynch out with broker downgrades for NAB. It's been cut to an underperform. We've got Macquarie cutting NAB to a neutral from outperform, and also cutting Westpac to underperform. Goldman Sachs, as you mentioned, doing that too to Westpac and NAB. There are broker rating cuts there too. I mean, do you think that the financials are going to really struggle today then, also because of what happened with the EU summit and the impact that had on the Spanish and Italian bank shares?
Yeah, look, it's difficult to say. I mean, I think there's no doubt the banks are going to be down today, but whether that's due to a couple of brokers coming out and downgrading them, I don't place any emphasis at all in terms of broker recommendations, so I certainly wouldn't be selling banks purely on that fact. I think the banks and the whole market will be down based on what we saw on Wall Street on Friday. So, you may start to see the banks under a little bit of pressure this week. Often when the markets have had a good run, people look for, sort of sector rotation opportunities. There's been a lot of people calling for some money to come out of the banks and go into the materials and the energy sectors, because they are leveraged to a turnaround story. And we have seen in recent days and weeks a little bit of stability in commodity prices. If you look at the iron ore price, it's risen from sort of that $85 range back into the $115 range. We've started to see signs of stabilisation across China. So some people might take some money out of banks and rotate into some of those cyclical sectors that are positioned for a turnaround.
I guess just looking too at the China demand story, I mean, how much was that in focus, do you think, in the falls in metals prices over the weekend, or was that more a kind of currency play going on there?
Yeah, look, obviously it was a real risk-off session rather on Friday night. We saw everything. We saw the US dollar stronger. We saw everything that was dollar denominated sell off a little bit. So, like I said, I think the data we've had out of China in the last 2 or 3 weeks is showing some signs of stability. We've got the Chinese handover happening early next month. There's a lot of talk that, with inflation pressures, back under 2% on a CPI basis, that there is room for, the incoming Chinese government to add further stimulus if needed. So I think, the Chinese demand goes through seasonal patterns, and I think we clearly saw a little bit of a slowdown for the last couple of months. But once some of these stockpiles of metal start to wear down, you are going to start to see Chinese buyers start buying again. So I'm not placing. I'm certainly not too concerned about the Chinese economy as a lot of people in the market are. I think they're going to be quite okay in the long term.
And just quickly, Cameron, are you expecting at all any impact on the market with the MYEFO, the mid-year economic update from the Treasurer today? Talk of big savings being seen, spending cuts and tax hikes. Could that impact equity markets at all?
Look, I don't think it'll have a big impact on equity markets. I mean, I haven't followed the story too closely. I read this morning that there's, they are going to be cutting out some loopholes in terms of salary sacrificing and raising the price of visas and whatnot. I think the government has realised that, they want to return to surplus, but they're not going to have, or there is going to be a bit of an earnings hole there with commodity prices not being what had previously been forecast. So I think, these spending cuts that are going to be announced today, I think will, not have too much of an impact on the market. Where it will have an impact potentially is in the currency markets, because I think it probably adds to the fact or the possibility of the RBA cutting or continuing to cut further if we start to see fiscal tightening on the government's behalf. So that would obviously give the RBA more room to cut rates if required.
Great to get your thoughts. Thank you so much for that, Cameron. Cameron
Thanks, Brian.
Peacock there from IG in Melbourne.